Price of gold has been fluctuating over recent days as investors shifted funds into the American dollar after the onset of the Middle East conflict. That has led to many questions about whether or not gold is still that safe haven that it traditionally is. Let's go to Helen Amos on this, Managing Director and Commodities Analyst at BMO Capital Markets. Helen, thanks for joining us today.
It's good to be here.
Can you shed some light on why we're not seeing people go to gold during a conflict like this one?
Yeah, it's a good question. I mean, what's happening at the moment is essentially that gold is showing a very tight inverse correlation to the US dollar. So when the US dollar started rising at the start of the conflict, as investors were selling emerging market currencies and currencies that were exposed to oil prices, that led to downward pressure on the gold price. Now, it was a little bit of an unintuitive move at first. We did see an initial bounce in the gold price on like safe haven demand. But really, I think, broadly, interestingly, the gold price has been behaving a little bit more like a risk asset over the last 10 days.
Okay, we were just looking at the chart. It's at about 5,200 US, I believe, today. Do you think it has bottomed out in this near term and will push up? Or what is your idea for a forecast here?
Yeah, I mean, I think, look, a lot of it depends on the pathway for the conflict. And as what you're seeing is that when the market starts pricing in sort of a near-term resolution to the conflict, you start seeing the dollar move down and then gold and other metals prices go up. And obviously no one really can predict that. One thing that we're watching really carefully, actually, is particularly ETF flows and central bank demand data. Now, ETF flows, we have kind of fairly a real-time view on, like a lot of the retail inflows, so the ETF flows, which is largely driven by retail, actually, over the last 12 months or so, has been driven by emerging markets. And so the reason why we're looking out for that is because really the emerging markets are getting hit by higher energy prices. A lot of them are, on a stage of their development where their energy intensity of economic output is on the rise. So they're going to be very vulnerable to, sustained increases in energy prices. And that applies to retail as well as, institutional demand and sovereign demand as well. And then the other thing is, central bank demand does come out on a lag. Now, this has been a real strong story for gold over the last 2-3 years. However, the World Gold Council did report a slightly weaker month for net purchases in January. I think they reported about 5 tons of net purchases in January. That compares with a monthly average of 27 tons a month in 2025. So again, a lot of that has been driven by emerging markets. So this is something we're really keeping an eye on as one of the kind of conditions for gold prices to keep rising from here.
Okay, so that's a significant drop-off that you mentioned in the buying by central banks. Do you see any reason for that? Does the central bank normally buy throughout the course of the year, or could you see a pickup in the second half of the year?
Yeah, I mean, there's an element of seasonality to it, but I have to say, like, even relative to, say, January a year ago, it looks a little bit low. Now, I think it's too soon to start extrapolating a trend from this. But, we did see a couple of banks sell some gold in January. And that's not unusual. We do see that from time to time. A bit of management of their reserves. So it was reported that both Kazakhstan and Russia did sell some gold from their reserve bank holdings. But nevertheless, we are also seeing buying from a number of countries as well, like Uzbekistan, Malaysia, China, Indonesia, and Serbia. So I still think on balance, the world has changed. I think emerging markets still want to keep doubling down on their diversification efforts. And definitely there's a lot of appetite to increase exposure to gold, particularly in light of concerns over ever rising government debt levels and this ongoing concern over the resilience of fiat currencies. So we're not getting concerned yet, but I would say at the moment with the conflict, it might be a bit of a rocky, volatile few days or weeks or even months ahead.
The Strait of Hormuz, I know metals get moved through as well, iron ore, aluminum, that kind of thing. I'm just wondering if you see sort of that backup affecting distribution or anything on that side of things.
Yeah, we would expect it to. I mean, essentially, there's minimal close to zero traffic passing through the strait at the moment. So that's affecting any commodity that usually passes through. So it's not just oil and gas, it's metals too, and fertilizers. So on the metal side, the two commodities that we've identified that have most supply risk are actually aluminium and iron ore. On the aluminium side, the region accounts for 9% of global production, which is a huge chunk. And not just our exports of aluminium being constrained out of the strait, but also imports of raw material like alumina. And on the iron ore side, we've got flows of the iron ore pellet feed going into the strait, and then pellets that usually flow out to Asian markets like China and India. And the region accounts for about 13% of global pellet supply. So we've got and actually the moves in the prices of those commodities have kind of reflected that supply side exposure. They've tended to, both those commodities have kind of outperformed the complex. So I would say that's where the most supply side exposure is.
Got it. I do have to leave it there. I'm out of time with you, but thank you for your time. I appreciate you joining us on the program.